We have looks like 3 or 4 dozen people signed up or signed on so far. Good evening, everybody. Thank you for joining us tonight. It's actually a good night to participate in a virtual home buying seminar. This is our 3rd of 4 that we're doing this spring. I'm Mark Antel. I'm with Vermont Federal Credit Union. I'm going to introduce our presenters tonight. The first one will be Megan Hampton. She's one of our illustrious mortgage originators here. Believe it or not, Megan is in the process of buying her first home, so she knows the ins and outs of what the process is, and I'm sure once we get to Elise's presentation, Elise is our guest realtor tonight from KW. Lisa will be doing the last presentation, but I'm sure she'll give you an update on the market currently here in Vermont. Second presenter is Eric Hoffman. He is the manager of business development and home ownership for Vermont Housing Finance Agency. He'll let you know about the programs that they offer, and that Vermont Federal Credit Union is one of their approved lenders allowed to use those programs to help first-time home buyers. So Megan, I'm going to give it to you. Go ahead, and please, everybody, if you have questions, please run through the chat box or the questionnaire answer box, and we will get to those questions as soon as we can.
Hi, everyone, and welcome. I'm Megan. I'm from the Burlington branch, and I am a mortgage originator. We are working remotely, so I'm able to work with people outside of the Burlington area. Let me get started. All right, so there's a few questions that you may have coming into this webinar. A few of them we'll be able to touch upon during the presentation. A few questions we have are, how do I know what my first step is when considering purchasing a home? Will I need a down payment? What do you take into consideration when determining if I qualify? What is private mortgage insurance, or PMI? And how do I determine what I can afford? And what are the closing costs and how much are they? Those are all questions we'll be going over during the presentation. Okay, so the home buying timeline. So the first steps that you're going to want to take when purchasing a home, getting started in the process, the first step is to meet with a mortgage originator for pre-qualification. This will help determine how much you'll qualify for, and other factors, what programs you may be eligible for. We will then send you a pre-qualification letter that you can take with a realtor. With that realtor, you can start to go shopping for homes, and when you find a home that you like, you'll make an offer. If the offer is accepted, you'll sign a purchase and sales agreement, and then you'll circle back with your mortgage originator to update your application. You may need to provide updated paperwork such as pay stubs or bank statements, and then the file will be submitted to underwriting for the final approval. Once underwriting approves the loan, you'll receive a loan commitment letter with conditions. And once all those conditions are met, you're on to closing. And at closing, you'll be able to receive the keys to the new home, and that will be your home. So there are a few other mortgage originators that I work with. There's Carrie, Lindy, myself, Marie, Patty, and Tina. We all work out of the branches, with the exception of Marie that works remotely and covers the Lamoille and Washington area. So really through Northern Vermont, there's plenty of originators to help you through the process. We offer a few mortgage products. We offer a conventional loan with a fixed rate or an adjustable rate mortgage, also known as an ARM. We offer VHFA programs that Eric will be able to go over more in depth. We also offer rural development for eligible areas in Vermont. We offer the VA loans as well for qualified veterans. When first meeting with the originator, the originator is going to look at different things to see how much you're going to qualify for. We're going to look at your credit, both your credit score and your credit history. We'll look at income and determine your income eligibility. And we'll look at something called debt to income ratios, which is your income versus what your debt is. And we'll go over that as well. And we'll also look at assets, what you have in the bank, or how you'll be paying for a down payment and closing costs. So when we look at credit, we're looking at your credit score. And credit is determined by a few different factors. So we're looking at your payment history. Have you been able to pay things on time? The amount you owe versus what your credit limits are, your length of history, how long you've had credit history, if there's any new credit, and if the types of credit that is used, such as if you have a mix between auto loans and credit cards and things like that. We also at Vermont Federal offer a program called Savvy Money. Savvy Money is a program that you can log on to right through your online banking. And there you can check your score. You can get kind of a personalized look at your credit report, how you can improve your credit score and things like that. So that's a really easy to use platform. And you can use that just by logging onto your online banking through Vermont Federal. So income. So when we determine how much you will be able to qualify for income, we look at your employment history over the past 2 years. We will gather 30 days of your most recent pay stubs. So if you're paid biweekly or semi-monthly, we'll grab 2. If you're paid weekly, we'll grab 4 pay stubs. So we just want to look at a total of a 30-day most recent pay stubs. We'll also gather your W-2s or your 1099s for the most recent 2 years. If you're self-employed, you're going to want to have a 2-year history, and we'll look at your 2-year recent federal tax returns. And we'll also look at a current year-to-date profit and loss statement as well. We also factor in other income, such as Social Security or disability, military, child support, or if you receive alimony. Those can all be used for income when purchasing a home. So we look at debt as well. We look at what the housing debt would be, so the housing expense ratio. So how much you would have as a payment towards the house. So we will look at things like your principal and interest payment, what the property taxes would be, the homeowner's insurance, or private mortgage insurance. PMI. PMI is going to be required if you put less than 20% down. So if you put more than 20% down, you won't need to pay PMI. If you put less than 20% down, you will pay private mortgage insurance. And that rate is going to be determined by what your credit score is, how much you're putting down, and your overall loan amount. And your housing expense ratio should really be between 29 and 30% of your qualifying income. We also look at your total expense ratio. So adding in your housing expense plus any other payments you have, such as auto, credit card loans, anything that would show on your credit report. And that number should be between 39 and 45% of your total qualifying income. So we have a few examples for you to look at when trying to determine income. So the first example would be if you have a purchase price of a home that was you're purchasing for $250,000, you put 5% down. So your loan amount would be $237,500 with 3% interest rate over a 30-year term. So to break that down, your principal and interest payment would be $101. Your property taxes, in this example, we're using $300 a month. For private mortgage insurance, we're using $91.04 for the monthly payment, and homeowners insurance at $60. So that's going to bring your total housing expense to $1,452. And if we look at an income of $5,000 a month, then your housing ratio would be 30%. If we then add in this scenario, a credit card payment of $125, student loans of $210, an auto loan of $300, then your total housing expense would be $2,087.35. And using that $5,000 a month income, your total housing expense ratio would be 42%. So we have another example here, this time using a purchase price of $3,000 and with a 5% down, so it'd bring your loan amount to 308,750 at a 3% interest rate for a 30-year fixed term. So the principal and interest payment for that would be $1,301.70. The property taxes, which would go up, so property taxes are going to go up as your purchase price goes up at $400 a month. PMI at $118.35. The homeowner's insurance at $60 a month, which would bring the total housing expense at $1,880.35. This example will use the monthly income at $6,500. So the housing expense for the scenario would be 29%. For this example, we'll have a credit card payment of $125, student loans for $300, and auto loan at $350, which would bring our total expense ratio to 41% in this example. So assets, so funds that are being used for a down payment and closing cost. We'll look at 2 consecutive months of your account statements. So either that can be the checking or savings, retirement accounts, mutual funds, trusts. We'll also look at gift funds. So you are able to receive gift funds for your down payment or closing costs. They just must be from a relative. And Eric will also go over a VHFA assist program that can help with down payment and closing cost assistance as well. Vermont Federal also offers their own closing cost and down payment assistance program. That program can offer up to $7,500 towards your down payment and closing costs. It is available for first-time home buyers or those who have not owned a home solely. It's for conventional mortgages only. So we talked about VA or USDA loans. We would not be able to use this program with those. It would need to be conventional. And it's for single family homes, approved condos, or approved double wide manufactured homes. And we would grant 3% of the purchase price up to $7,500. There is a household limit of $125,000 with 100% maximum combined loan to value. With this program, the funds would need to be returned if you refinance, you pay off, or if the property is sold in less than 15 years. If after 15 years, it is completely forgivable for that program. All right, Mark, back to you. That's my last slide.
A couple of questions, Megan. 2 of them are almost identical. For qualifying income, are we using gross income or take-home income?
Gross income.
Okay. And the other question, I'll answer this. Someone is asking if they can get a copy of the recording of this presentation. That would be for everybody. What we will do next week is on our website have this presentation posted, so you can, or social media, so you can go there and listen to it as often as you'd like while it's posted at that time. Any other questions for Megan while she is still here? If not, we'll move on to Eric.
I think there's a question of how much time does it normally take to get a mortgage approved after the agreement is signed? And that's a great question. So I believe that's when you have a contract, how long it will take till it is approved. And that is going to be, so what happens is once you have that contract from your agent or realtor, you're going to want to send that the purchase and sales contract or purchase and sales agreement to your originator as soon as you can. And that will let us get started on starting the mortgage application packet, which is going to have disclosures and will be mainly together information and income. Once we have everything, I would say, Mark, correct me if we're still on this timeline, about 5 to 7 business days from once we have everything until an underwriter can give that final approval. From there, with the conditions, one of them being appraisals, those can take a while until we get to the closing table, but your commitment letter and your conditional approval, I would say about 5 to 7 business days after we have all the required documents. Are we still on that timeline, Mark, would you say?
That is correct. Yep. One more question. Is there a limit on how much a relative can gift for a down payment?
Don't believe so. They would have to fill out a gift letter. So what they would do is they could either wire you or send you a check to your fund. We would need proof of those funds, and we would also have all parties sign a gift letter. One thing that you want to keep in mind is, so there are some limitations on a few of the programs that we offer for closing, both the Assist and the SEED program, and those will count as assets. So depending on what program you are, there may be limits to the gift funds that you're able to receive and still have that program.
And the key on gifts is that it does in fact have to be from a relative. Can Megan speak to closing costs? I'm just going to run this by best thing on closing costs, because different programs are designed to have different closing costs. It's probably best to submit an application, have one of our originators get back to you and run different scenarios based on the closing cost. But ballpark, plan on 2.5% to possibly 3% of the purchase price as far as what total closing costs will run.
I think there's one more question. Are there limits to savings and 401k, et cetera, for the seed money for closing? We do look at your savings. There is a $30,000 limit for assets. However, if it's a 401k or retirement account, we will not take that into consideration for the $30,000. But any investments or savings or checking accounts, $30,000 would be the limit.
Another question, Megan, I'll take this one. How long is the pre-qualification good for? Generally, what we recommend, it's good for 60 days or so. And we're counting that you're not going to add any additional debt, because part of that process is us pulling credit to see exactly what your other debt is currently. And the credit report itself is only good for up to 120 days. So what we recommend, if we do send you a pre-qualification letter and you go out shopping and you haven't found a property, to check in with us to make sure that you haven't added any other debt, your income is still the same. We'll be happy to issue an updated pre-qualification letter based on that. Question, Megan, I'll take this one too. My pre-approval letter says that I can put 5% down. Is that a maximum? No, there's no maximum. There's actually programs out there that offer up to 100% financing, rural development being the most common. So essentially with that program, you don't have to put anything down, but you can put as much as 95% down and take out a loan for the balance of 5%. So no, there's no minimum as far as what you can put down. Really,
I believe the passion. You are small.
I was interrupted there by some chatter in the back.
Oh, is that me? Sorry.
No problem. So yeah, usually if you're going with a conventional type mortgage, the minimum required is 3% down. You get a slight break on monthly mortgage insurance if you put 5% down. And if you put less than 20% down, you will have to have mortgage insurance. And that mortgage insurance premium goes down the more you put down. Once you hit 20% down, there is no monthly MI whatsoever. So for now, I'm going to hold off. Eric, let's get you going on your presentation. And again, any other questions, keep sending them in. We'll get to them as quickly as we can.
Eric, I think you're still muted. Oh,
There we go. I'm unmuted. All right. My name is Eric Hoffman. I'm from Vermont Housing Finance Agency. Can you guys see my screen? Yeah. Okay. So how can VHFA help you? So let's get started here. So for any loan, this is how I look at it. You're looking at three things. There's a lot of details, a lot of numbers are going to be thrown at you. You're kind of looking at three things. You're looking to minimize or be comfortable with the closing costs and the down payment required that you're going to be making. You want to be comfortable with any monthly payment that you're going to have for any amount of money that you're borrowing. The third thing is probably the best part of it is how much can you afford to borrow, right? How much can you go into the market to shop with? So those are kind of the three things. A lot of the other stuff is kind of details, right? So that's where VHFA can help. We are a mission-based Vermont nonprofit housing organization we're here to provide as best we can low-cost loans to help eligible home buyers to lower their upfront and monthly costs. All of our programs are offered through local participating lenders like Vermont Federal Credit Union. We have a handful of other participating lenders spread throughout the state, but Vermont Federal Credit Union is one of our top performing lenders. And so you wouldn't come directly to VHFA for any programs or any loan programs. We don't sell homes or anything. We offer loan products that you can go to local lenders, local banks, credit unions, mortgage companies to see if you're eligible for, see if that's a good fit for you. So talking about closing costs, somebody had a question about this. So I threw this slide in here. So just giving you an example of some of the numbers on closing costs, and Mark is right. It really varies very much from property to property. So this is a very rough ballpark about what closing costs are. But if we look at a purchase price of $200,000 as an example here, and you have a down payment requirement of 3%, then the down payment for that purchase would be $6,000. You add on top of that what are called closing costs, which are the costs to get the deal done. And it's kind of like when you go to buy a car and you are paying for tax, title, and registration before you can drive the car off the lot. Same kind of thing. Although it's a house, there's going to be a few more expenses than there is with a car. So the total upfront for a 3% down loan might be in the neighborhood of $14,000. There is a 0% down option. That's through something called the USDA, and that's something that you can pair with VHFA or use it on its own. And that is where you could put as little as 0% down, but you would still have those closing costs. So the total upfront costs would be $8,000 in this example. Again, this is for estimated purposes only, so it does vary, and it is something that you can certainly ask somebody like Megan or a loan officer that you're working with, hey, what are my estimated closing costs on this, when you get your pre-qualification and throughout the process, so that you can get an estimate of what those upfront costs are going to be. Okay, so talking about how can VHFA help with those closing costs and down payment? Well, Megan touched on this a little bit, but we have loan programs, or we work with loan programs that are offered through lenders like Vermont Federal that require as little as 0 to 5% down for the minimum closing costs, or I'm sorry, for the minimum down payment. We also offer something called VHFA Assist, and that's where you can get up to $7,500 for down payment and closing costs as long as you're eligible. And I'm going to talk about eligibility here in a few slides. We also offer for anybody who is using a VHFA loan something called something called savings on the Vermont property transfer tax. So savings up to $825 on a tax that all buyers have to pay when they buy a home in Vermont. Just talking a little bit more about VHFA Assist. It's a 0% loan. So it is a loan, but it's at 0%. So you get that first purchase mortgage, that 30-year fixed rate mortgage, and you might get that at, I think the prevailing interest rate is about 3.125 these days. And then if you wanted to get help with those upfront costs, so you didn't have to pay as much out of pocket, you could get this 0% assist loan. And that would basically just sort of sit in the background until you sold or refinanced or paid off your first mortgage. Once you sell, refinance, or pay off your first mortgage, then you would also pay back that assist. It would go back to the state, and in theory, it will go back out to the next home buyer that is looking to use that. Again, there's no monthly payment, so it's like a deferred loan. Help with the monthly payment. Well, we offer competitive interest rates. We also offer lower private mortgage insurance when you're using certain programs. Those certain programs are Fannie Mae and Freddie Mac, those conventional programs. We offer something called a mortgage credit certificate. Vermont Federal doesn't offer this. I'm not going to go into too much detail with the mortgage credit certificate, but it is something that could help with your federal tax liability year over year as you live in the home. So if you're interested in learning more about that, go to our website. I'm going to give you contact information after this where you could contact me if you wanted to. As far as checking our rates and information about our programs in general, VHFA.org is the best place to go. Eligibility requirements, right? What are the eligibility requirements? So for income limits, there are income limits. This is kind of where we start, is what's your income? We use gross income, gross annual income, and that is the income that is before taxes, before any deductions of any kind. And we take a look at all borrowers, anybody who's going to be on the loan, and what we call non-borrowing spouses. So if you have a significant other and they're a spouse, then we're going to count their income even if they're not on the mortgage. Sometimes people will leave off their spouses because maybe there's credit issues or there's some reason why. But for VHFA, when we're calculating whether you're eligible for our programs, we're going to use that income. It's based on the program, the type of VHFA program that you're using, the county, the household size. Go to our website and check out those limits if you want to. There's also a worksheet on there, so you can kind of work through it to see what your income would be according to the way that VHFA calculates it. So, that'll help you to know where you stand sort of when you go to talk to somebody like Megan for a pre-qualification. A little bit more about assist, the eligibility requirements for assist. So again, all borrowers and non-borrowing spouses must be true first-time home buyers. So we're looking at anybody who's on the mortgage and any non-borrowing spouse. And all of those folks in your household need to be true first-time home buyers. No real estate interest owned in a principal residence at any time prior in their life. So sometimes this comes up where somebody has received what we call a spousal benefit. Maybe you've been on living in a home where you weren't on the mortgage or you weren't on the deed, but you still received a residence benefit or a spousal benefit. That would disqualify you from being able to use VHFA because you wouldn't be technically a first-time home buyer. So again, just letting you know what those eligibility requirements are. There is a liquid asset limit. So there is a limit. Somebody was asking about a limit on gift funds. Now, in general, it's program to program. In general, there's not a limit. For VHFA, there is. You can't have combined savings for all borrowers and non-borrowing spouses more than $30,000. And also that includes gift funds. So if you're planning on receiving gift funds, your liquid assets, your non-retirement assets, plus any gifts can't equal more than $30,000. As long as they're below that, then you could still use assist and keep some of that money in the bank if you wanted to. And also, one borrower must complete homebuyer education and counseling, and that would be something you would work with your loan officer to know how to complete that. This tonight is an informational webinar, so this doesn't count for that. There's a larger homebuyer education and counseling out there that would help you. It really is beneficial because it gives you the A to Z's about home ownership and what to expect during the process. buying a home, also a little bit of financial education in there, if that's useful for you. Eligible property types. So you could use VHFA to help you finance a number of different types of properties: single family or a condominium, manufactured home on owned land, duplex purchase. Although in this market it might be more difficult to find an affordable duplex, but you could potentially use VHFA to do that. Shared equity programs, and our purchase price limit is between 270 and 350, depending on the program and the county. And those limits, again, are on our website if you wanted to check that out. And as far as some of you might be saying, what is a shared equity program? I'm going to put Megan on the spot. I'm not going to ask you tonight to describe that, but if you are interested in that, I think Megan has a lot of knowledge about purchasing shared equity. Is that correct? Okay, good. She gave me a yes.
And we work with different programs that can offer that can be obviously paired with VHFA. So happy to have anyone email me with questions about them.
Duplex purchases, you might have these questions in the back of your mind. You might be thinking, oh, what if I do this? So I'm going to bring it up here. So you could use VHFA to help you finance a duplex as long as it's existing, not new construction, not brand new. Well, not brand new, but not something you can't use VHFA to finance the construction of a duplex. Both units have to be residential for the prior 5 years. So you couldn't buy a building and be converting a retail space into a residential or tenant space. 3 to 5% down is required. One thing to remember is that you will have to show reserves. So you will have to show savings even after you close. So after you move in, you'll have to show, it's usually 2 to 6 months of savings. And that's really just to make sure that you would have the expenses or the savings to cover. Maybe you didn't have a tenant when you thought you would, or you had an unexpected repair. A lender wants to know that you'll have that sort of cash on hand to be able to handle those unexpected events. So check with your participating lender early in the process, your loan officer that you're working with early in the process, if that's something you're thinking about. And certainly you're talking to your realtor too about what you're going to be looking for with a duplex purchase. For manufactured homes, again, just get these questions sometimes. Just wanted to bring this up here. If you are interested, VHFA will allow you to finance something that's no less than a multi-width. So it has to be double wide or larger on owned land. So not on any leased land or in a park setting. No more than 15 acres. And so that's a VHFA wide requirement, is that the acreage can't be any more than 15 acres. 0 to 5% down, depending on the program that you use. Has to be 2001 model year or newer. This just changed. I just haven't updated my slides. So it has to be no more than 20 years old, or brand new if you're using 0% down, 0% financing. Another question I get, and I would just like to bring up, is interested in a fixer-upper, right? You're all resourceful home buyers and you're looking for an edge in this competitive market, right? So interested in a fixer-upper? Well, VHFA could help you with a fixer-upper, but like any mortgage program that you're going to find, any loan that you're going to find, they're going to want to make sure that the home meets certain minimal condition standards. And what do we mean by that? Health, safety, structural standards. Health meaning no major asbestos abatement, mold issues, maybe lead. Safety meaning, the electrical systems are all in good working order and aren't all, all old knob and tube from the 1910s. Structural meaning is the foundation, are there any, real major cracks or real big roof holes or anything like that. So if you're interested in this part of the market too, it's good to consult with your lender early in the process, just to know what those minimal standards are going to be, communicating those to your realtor and using your realtor as a guide to say, oh, these are some serious red flags here we got to look out for. So that's just a little something about fixer uppers that I see home buyers ask often. But you could definitely use VHFA to help you with a fixer upper as long as it meets these minimum standards. Okay, so how to get started? Well, like I said, we have Lots of participating lenders, of which Vermont Federal is a top performing lender. They've been the top performing lender for years and years. So I encourage you to start here, but there's others across the state that offer VHFA programs. You can find those at our website at vhfa.org. And we're on Facebook, we're on Twitter, we're on Instagram. So follow us there for more information if you want. You can also contact me at VHFA homeownership at vhfa.org. And my name is Eric Hoffman. I'd be happy to answer any questions that you have. Okay. Thank you. Thank you all. I guess I'll hand it back to Mark.
Great job, Eric.
Thank you.
No new questions other than somebody's asking about credit scores during the pre-qualification process. I'll answer that. As long as you don't do anything wacky, like take on a whole bunch of additional credit or start making late payments, your credit score should not go down. I would suggest, and we suggest this to everyone, that if you are shopping for a mortgage, don't go to 20 different mortgage lenders and allow them to pull credit on you, because that will definitely affect your credit score in a negative way. But overall, your credit score should not change as long as you as a potential borrower aren't changing your habits, and just make sure you continue to pay all your bills on time, and don't take out any additional credit. So with that, I'm going to hand it over to Elise.
All right. Good evening, everyone. Thanks for joining us. So excited to be here and talk with you all about now the home buying process from the perspective of the real estate agent and going out and looking at homes together. So as Mark said, my name is Elise Polly. With KW Vermont, I'm the owner of Polly Properties. I like to say that we're a small but mighty real estate team. There's about 400 agents in this region. And last year we were ranked number 10 out of those hundreds of agents. So we have lots of experience, and we have lots of experience working with first-time home buyers. So we're always happy to answer any and all of your questions. So this is just speaking more to the team's experience. I'm going to go over that and get into the meat of what you want to learn about, which is why use a real estate agent. So a lot of people do ask us this question, if it's necessary to use an agent. According to NAR, which is the National Association of Realtors, 1 in 10 buyers purchase a home that they found online. So why does that matter to you? Well, we all know that you're spending hours and hours looking online. You're looking at Zillow and Trulia and Craigslist and all these places trying to find your ideal home. And based on just those odds alone, chances are you're not going to find your ideal home just looking online. You could probably use the help of a real estate agent. So 87%, according to the Association of Realtors, 87% of people use an agent to help them in the process. So another important reason to use an agent is that we're going to really negotiate really hard on your behalf. So we care and we're motivated, right? So the real estate agent, which we're going to get to, is only paid at the closing table if you purchase the home. So with that, we're highly incentivized to really be your best advocate, to fight for you for the best price, terms, and condition. We also have a great pulse on what's happening in the market. So we can really speak to, right now, the majority of offers we're seeing, people are going under the listing price. Or it might be, the majority of offers that we're seeing right now, people are going about $5,000 above listing price. Or perhaps we'll say it's about $20,000 above listing price. But we're just going to have that insider knowledge to let you know what to expect. So we're also going to provide that coordination throughout the whole process of the transaction. So we always start first with a home buyer consultation. This is our opportunity to really get to know you, what your wants are, what your needs are, to talk about the market and what to expect. And then we're there holding your hand, walking you through it from A to Z up until the closing table and often after closing as well. We certainly have a really good pulse as well on people to recommend. So lenders such as Megan or VHFA or home inspectors, attorneys, if you need any service providers, we've kind of seen the good, the bad, and the ugly of all those people in the industry. So we're happy to make all those recommendations for you. Most importantly, when it's time for you to write an offer on your house, your dream house, we are there to do that market analysis. So we're going to give you a really good idea based on our homework, right? We're going to pull comps of, this house is either priced on the nose, it's underpriced, or it's overpriced. So we're able to guide you based on that data as far as your offer that you want to create. The other thing that we can do is once we are working together, we have an agreement to work together, is we keep all of your information confidential. And then last but not least, the most frequent question that we get from first-time home buyers is, what does it cost to use an agent? And it actually costs you nothing. So anything that's in MLS or the multiple listing service, the sellers have already agreed to paying a buyer's agent. So that's a non-negotiable. It's already in writing. The seller is already signed on the dotted line to do that. So it costs you nothing. And then in the case of a for sale by owner, we negotiate for a living. That's all we do, 7 days a week, 365 days a year. We have an amazing track record of negotiating with for sale by owners as well. So when you're thinking about starting this process, which, it's a lot to think about, a lot to take into consideration, I always like to think of it in terms of you, the buyer, being in the driver's seat, and you are bringing this all-star team around you. So you want, the best possible attorney, the best possible lender, the best possible agent, home inspector, and home insurance provider. So just keep in mind as you go through this process, you're really in the driver's seat. So you're the one bringing these people onto your all-star team, and then we're all there to support you in our different roles. So this slide is showing you really from A to Z what you can expect from the process as far as working with an agent. So the first thing that you want to do is, just like you might interview a few mortgage lenders, loan officers, you also might want to interview a few real estate agents. So after you've selected those people and you have your pre-approval in hand, then we get to do the fun part of looking at homes. So a very common question we get is, how many homes do buyers look at on average? And I'm going to say on average, most people are looking at about 5 to 8 homes. And that's not to say that people don't maybe look at one home and write an offer on the first home that they ever see, or the other end of the spectrum. Some people might take looking at 30, 40 homes until they find the right one. But I would say on average, we're looking at about 5 to 8 homes. So when you find that home and you're excited, obviously the first thing that you want to do is tell your real estate agent. And either they're going to ask you, like I'll ask clients during showings, is this the one? Or you're going to tell them, this is the one. And then you're going to get together to write the purchase and sales contract. Again, this is an opportunity for you to learn what all the legalese means in that contract. So we always like to go over each and every clause of that contract together so that you know exactly what you're signing your name to, because it's a lot of big decisions. A very normal part of the process is that we're going to be doing some negotiating. I think that most first-time home buyers assume that the negotiations are all circled around price, and that's not always quite the case. So we could be negotiating what closing date is more preferable for the sellers, or perhaps you asked to have the heating system inspected and the sellers had just done that and they can provide a receipt. So there's going to be this very normal back and forth as we go through the negotiation process, in addition to just the price. So let's say your offer is rejected. That can happen, especially in this competitive market. We're just going to look at more homes. We're going to find you an even better home. And I know it's hard to believe this in the moment because you might feel devastated, but it always works out every time that we're going to find you a home that's a better fit, and it's going to be the better thing in the long run. So just keep faith in that. So once your offer is accepted, then you're going to go back to Megan or whoever you're working with, and they're going to get going on their end of things. Simultaneously, we're going to be helping you schedule that home inspection and any other inspections that come along with the purchase of your home. So it might be, if it's a condo, reviewing the condo association rules. If it's a single family home with a well, it might be testing the water. So all those things, we're there to walk you through that process. Also simultaneously, you're going to be hiring your attorney. So again, that's part of your all-star team, that team that supports you. They're going to be in charge of doing your title search and your title insurance. And then they also are going to run the closing for you. So they have a very key role in the process. Then you're going to hear back if the home appraises or not. So this could be a point of renegotiation. So if the home appraises at the price that you offered or higher, we're going to do a little bit of a happy dance and a celebration. If it comes in lower, then that's going to be a point of renegotiation. So you're going to consult with your agent and go from there to figure out a game plan. So once the loan is completely approved, we're a step closer to getting to that closing table. Right before closing, we're going to do one last thing, which is your final walkthrough. I like to think of it as a mini home inspection. So we're going to make sure the fridge is cold. We're going to flush toilets, make sure there's no new leaks in the home. We're going to run water in the sinks. Even in the summer, we're going to pump up the heat and make sure that your heating system works. So that's that one last check, that check and balance system to make sure that your home is as we saw it during the home inspection. And then we get to go to the closing and you get your keys and you get to celebrate. So let's talk about making the offer. So as I believe Eric alluded to, we're experiencing a pretty tight seller's market at this time. The market is going to depend on what price point you're purchasing at. So definitely feel free to reach out to me after if you would like to learn more about your specific price range and how competitive it is. But we always recommend, first of all, we start off by asking you, okay, on a scale of 1 to 10, 10 being the perfect home, where does this home fall? If you tell me it's a 9 or a 10, then my advice is going to be to make a pretty competitive offer. If you say, it's a 7 or an 8, then let's talk about ways that hopefully we can get you down in price and get the best price terms and condition for you. So I think really the most important part of writing that offer with your agent is just being completely honest and having that honest conversation with them about how much you want the home. So you don't want to wake up the next day and get that phone call that you didn't get the home and lose it over $1,000 and then say, I wish I had just gone $1,000 higher. So we're there to have that conversation with you and guide you on that. So there is my contact information. Are there any questions on this portion?
I'm not seeing any yet, Elise, but we're still open for questions. Let me answer a few that came in concerning credit scores. On the lender side, it is in fact a hard pull. We actually pull from all three credit reporting agencies at the same time, and you're qualified based on the mid score of whoever is on the application. So if you have two borrowers on one application, we're going to pull credit for both of you. You'll each have 3 credit scores that show up, and we will choose the mid score, the lower of the 2 mid scores for qualification. Another question on credit was what does the credit score need to be? And the best answer I give you for that, it really depends on the program that we can get you into. So some programs are more lenient on lower credit scores, but it's always best to have the best credit score possible. Things get a little funky if your credit score is under 680, the credit score that we can use. You may still qualify for a mortgage, but the guidelines, the loan to value, you may have to put more money down. Your debt to income ratios are going to tighten up the lower your credit score. But again, it really depends on the program that we can get you into. Let me take a look here.
Looks like there was a question about if real estate agents have more access than what people can see on Zillow. And my answer is absolutely yes. So this year alone, I've had 7 homes that never hit the internet. They never hit MLS, simply because we were able to find buyers for them before they ever hit the open market. So most agents are going to have what they call pocket listings. So I often have pocket listings, and the people who get first dibs on those pocket listings are our clients. Another thing that we do is we'll basically leave no stone unturned. And I'm going to give you a quick example. I had a client wanting to buy in the New North End of Burlington. So we started off by doing mailers to the neighborhood that they wanted to be in. Then we went door knocking to the neighborhood that they wanted to be in. Then we went through our database of thousands of people who live in that neighborhood, and I called hundreds of people in the New North End in that neighborhood that they wanted to be in. So don't think of purchasing a home as just what you see online. If you truly have a dedicated real estate agent, they're going to leave no stone unturned to find you that right house.
Megan, a couple questions for you. How are closing costs paid? Can closing costs be rolled into the loan amount? Do they have to be paid separately? And along with that, what is a typical inspection fee and appraisal cost?
All right, lots of questions. So the closing costs and actually the down payment are going to be paid at the time of closing. So those two will be rolled in together. We will need the appraisal fee prior to the closing. And that can range, depending on the property in the county you are, anywhere from $500 to $650. I'll let Elise touch upon the inspection, what she's seeing for costs, but that will also need to be paid prior to closing. And your realtor, Elise, will be able to help you kind of guide you through that inspection process. What was the other question, Mark?
Can closing costs be rolled into the loan amount?
Gotcha. So they cannot be rolled into the loan amount. However, different programs such as the SEED and VHFA have a second loan that will be able to help you with the closing costs. But I'll let Elise speak a little bit more for the inspections.
Sure. So the basic home inspection can be anywhere from $400 to $650. Some inspectors do charge per square foot, and others, I think the majority in our market, do just a flat rate, regardless of the size of the home. And then it also, if you're going to have, let's say, your water tested, that's probably, about $150 to $250. If you want to do a radon test, that's usually about an additional $125.
trying to think.
Please-
Mark, was there any other questions that I didn't answer in that grouping?
I think you're all set for now,
Okay.
Megan. Add on to inspection question, Elise. What do you typically see as far as what the inspection covers?
Sure. So most inspectors are going to say that it's not invasive, so they can't drill a hole in the wall to see what kind of insulation is behind that drywall. So it is usually purely visual. However, they're going to go up into the attic. They're going to measure the insulation in the attic. They're going to run water. They're going to look for leaks. They're going to open every single door, every closet door, pantry door, make sure that everything opens and shuts properly. Same thing with windows. They are going to take down the codes from all appliances, and they have a program which they can look up the appliance by the code number to see if there are any recalls. So I have seen that more frequently than you would think, that there are appliances in people's homes that have recalls on them. The most common thing that we see come out of home inspection is electrical issues. Electrical code changes on a daily, monthly, annual basis. So it's pretty easy for a home to have outdated electrical concerns.
Question came through on verification of income, sports betting, that type of thing. Essentially, we can't use any of that for qualification purposes. What we can use is whatever shows up on in a situation like that. If you're declaring that income on your federal tax returns, then we can in fact use that type of income. But unless we can verify that you're declaring that income, we cannot use it at all. That's just Fannie Mae, Freddie Mac guidelines, which we have to abide to. So unless we can verify, the simple answer is if we can't verify the income, then we can't use it for qualification purposes. Let me see here. Megan, what are the pros and cons of purchasing as a couple or only putting one name on the mortgage?
Yeah, so that's going to be on an individual basis. So sometimes if we always use between two borrowers, the lower credit score. So if one borrower has a lower credit score, it may be preferable to use the higher credit score and leave the other borrower out. That being said, we won't be able to use the borrower's income unless they're on the loan. So you don't need to have both parties on the loan, but the more income you're bringing to the loan application, the higher your pre-qualification will be. So that's, sometimes if people have the two borrowers on, is really to get that stronger income. However, sometimes if one borrower isn't working, perhaps they're in school or they're a stay-at-home parent, and they have a less than favorable credit score, you can absolutely leave them off of there. So it's really on a one-on-one basis, whether or not it's going to be better for you to have both borrowers on or just one.
Megan, your opinion on using Credit Karma or any other free reporting?
Yeah. So like I said, we offer Savvy Money, which is very similar to Credit Karma. I think that's a great program to get a very good sense of where your credit score is. They also offer helpful hints on how to increase your credit score, which can be great. However, the credit score in Credit Karma may not always match to what we pull. So it's a great way to get an idea of your credit score, but it may not be 100% accurate, but it does have a pretty good idea of where you would fall.
And where could they find that Savvy Money on our website?
So they have to be a member. So if they're already a member, they can log on to their online banking and they'll be able to see the Savvy Money and click on that to get that score, but they would already have to be an existing member with us. I also see on my end, I don't know if you see it, where should I roughly, what should I roughly get my credit score up to before being pre-approved? And I think you had touched upon that, but around 680 is a great starting point. However, we can work on an individual basis if it's lower to see if there's any contributing factors, but 680 is a great way to try to get up to. We also offer another boost for credit scores, we offer a program called the Credit Builder Loan. So if your credit score is less than favorable, definitely reach out to Mark or myself, and we can get you in touch with a member service representative that can also help boost that credit score as well with the Credit Builder program.
Megan, you want to touch on using commission income?
Yep. So commission income can absolutely be used. We're just going to want at least usually 2 years of that commission income. We also want to make sure that it's healthy, that it's not a steep decline. And what we'll do is we'll just grab your W-2s for the 2 previous years and a pay stub. And once we look at those, we'll be able to make a determination whether or not it's usable and how much we're able to use.
How many people can be on a loan, Megan?
I believe our program is up to 4 borrowers, and they can be either borrowing with you and living at the home, or they can be something called a non-occupant co-borrower, which means they're helping contribute to the loan with their income, but they're not actually living at the property, and you can have up to 4 borrowers.
I'll take this one. What credit bureau does Vermont Federal utilize? Equifax, Experian, or TransUnion? Actually, all 3. If you're applying for a mortgage, that's where we're pulling those 3 scores from, and we will take the mid score of those 3 from the all borrowers that are applying for the mortgage. Are there options for borrowing more money than a house is worth to use for home updates? To answer your question, in the purchase part of the transaction, not with Vermont Federal Credit Union, we don't have a program like that. There are programs with other lenders that they're called rehab loans, where they will finance up to 95%, I believe, of what the home would appraise for if the work had been completed. You'll find that the interest rate is considerably higher than a conventional type mortgage. But to answer your question, those programs are out there. Vermont Federal just does not offer them at this time. Anybody else seeing any other questions that haven't been addressed? I'm not at this point. So with that, that'll wrap it up for this evening. Want to thank Erin Gamache. She's in that right-hand box of marketing, hiding herself. She's the one that put this presentation and all the marketing behind it for the 4 of us. So thank you, Erin, again. Thank you, Megan, Eric, and Elise, and thank you all for attending. Again, we'll be posting this on our website and social media sometime next week. So if you want to check it out again or share with friends, please do so. If you have questions, Erin has popped up all of our contact information, and please feel free to give us a call with any questions at any time. Thank you, everybody. Have a good night.